The more control traders feel, the more risk they usually take. And the market has a habit of punishing fake control. If you've ever felt that you almost had it, that you were one adjustment away from cracking the code, you've already experienced the illusion of control. It's one of the most expensive psychological traps in trading because it doesn't look like a mistake. It looks like competence. Trading attracts people who want mastery, people who want to understand systems, patterns, cause and effect. And in many domains, that mindset works. If you practice a skill, your results improve. If you refine your technique, your performance increases. If you study the rules, you gain control. Markets don't work like that. Markets contain uncertainty that cannot be eliminated. They include randomness, regime changes, information you don't have, and behavior you can't predict. And because the brain hates uncertainty, it tries to replace it with something that feels better. Control. This is how the trap begins. You open your charts and you add tools. Indicators, oscillators, volume profiles, moving averages, support and resistance, multiple time frames, custom settings. You create alerts, you build watch lists, you track news, you monitor sentiment. The system becomes complex, and complexity feels like power, but activity is not edge. Information is not control, and more tools do not automatically lead to better decisions. The illusion of control is the belief that your actions can meaningfully influence outcomes that are largely random. In trading, that belief is incredibly seductive because the feedback is immediate. You take a trade. Price moves, you feel a rush, sometimes it works, sometimes it doesn't, and when it works, your brain learns the wrong lesson. I did something and I was right. Therefore, what I did caused the outcome. But one correct prediction is not proof of control. It's one data point in a probabilistic system. Here's what most people get wrong. They believe that precision equals profit. They believe that if they can refine entries, tighten timing, or filter signals more intelligently, they can reduce uncertainty. They think trading is an engineering problem. In reality, trading is mostly a behavioral problem. You can build a system that's theoretically profitable and still lose money if your behavior collapses under uncertainty. And the illusion of control is one of the fastest ways to collapse behavior because it encourages overconfidence, overtrading, and emotional micromanagement. Let's break down how it shows up in real life. First pattern, the indicator addiction. A trader starts with a simple method, maybe a trend-following system, maybe a basic breakout setup. They take trades, they experience losses because losses are normal in trading. But emotionally, losses feel like a problem that must be solved immediately. So instead of accepting variance, the trader tries to eliminate it. They add an indicator to confirm the setup. They tell themselves it will filter out bad trades, then they lose again, so they add another indicator and another. Now they have a stack of conditions. If RSI is above X and MACD crosses and volume confirms and the candle closes above the level and the higher time frame agrees, then I enter. On paper it looks smart, it looks cautious, it looks controlled. But what actually happens? The system becomes harder to execute. Signals become rare. When signals appear, the trader hesitates, or they miss entries, or they chase late, or they override rules. And when a trade fails, the trader doesn't question the core logic. They assume the system needs more precision, so they keep adding. This creates a dangerous cycle. Losses create discomfort. Discomfort creates complexity. Complexity creates inconsistency. Inconsistency creates more losses. And the trader keeps trying to fix the feeling by adding more control. Second pattern, real-time micromanagement. This is the trader who cannot let a trade breathe. They enter with a plan. They have a stop, they have a target, they know the rules. But as soon as price moves against them, the nervous system activates. They start watching every tick. Every candle becomes a story. Now the trader feels the need to manage the trade. They widen the stop just a little. It's going to bounce. They reduce the target. Let me take profit early. At least I get something. They move the stop to break even too early. I don't want this to turn into a loss. They exit, then re-enter. I got shaken out. What's happening here is not analysis, it's emotional regulation. The trader's using actions to regulate anxiety, and the more anxious they feel, the more actions they take. But in trading, more actions often means more mistakes, because reactions are usually driven by fear, not logic. Third pattern, the fantasy of control through timing. A trader believes that the difference between winning and losing is perfect timing. So they obsess over entries, they refine the exact candle, they try to enter at the best price. They delay because they want perfection. They wait for one more confirmation, then they enter late and feel frustrated. Or they enter early and get stopped out. Then they tell themselves they need even more precision. The truth is uncomfortable. In many strategies, entry precision matters less than the trader thinks. Risk management and consistency matter more. When traders believe they can control outcomes through perfect timing, they ignore the real levers: position sizing, risk per trade, maximum daily loss, and exposure. Now let's connect this to the real core. Markets are not controllable, but risk is. You cannot control what price will do after you enter. You cannot control news. You cannot control other participants. You cannot control randomness. What you can control is your exposure. Real control in trading is not prediction. Real control is risk management. This is the mindset shift that separates survival from destruction. Most traders try to control the market. They fail. Profitable traders control themselves. They design systems that assume uncertainty and still survive. So what does real control look like? It looks like position sizing that you can emotionally tolerate. If a small move against you triggers panic, your position is too big. If you're watching every tick, your position is too big. If you're breaking rules under stress, your position is too big. Real control is using sizes that allow you to execute your rules without emotional hijacking. It looks like defined risk per trade, not I'll see how it goes. Defined. Because if risk is vague, you will negotiate with yourself when fear appears. It looks like limits, maximum loss per day, maximum number of trades, maximum exposure. Rules that prevent you from turning trading into emotional gambling. This is why control is a paradox. The trader who feels the most in control is often taking the most risk. They're often the most exposed. They're often closest to the edge of emotional breakdown. And the trader who actually has control often looks boring. They trade less, they are repetitive, they follow rules, they accept losses as normal. They do not try to force the market to behave. Now let's address a key misunderstanding. People think that accepting uncertainty means being passive or careless. It doesn't. Accepting uncertainty means building a process that does not require certainty. It means you stop asking, how do I know I'm right? And you start asking, how do I survive if I'm wrong? That question changes everything. Because in trading, being wrong is normal. Even great traders are wrong frequently. What matters is the cost of being wrong. So here's the correct logic. You don't need to control outcomes. You need to control downside. You don't need to predict. You need to manage distribution. You don't need perfect timing. You need consistent execution. You don't need more tools. You need fewer decisions. If you remember only 3 things from this video, first, if you feel the need to manage a trade emotionally, your risk is too high. Trading should be rule execution, not emotional negotiation. Second, rules beat reactions. Your best decisions are made before the trade, not during the trade. Third, fewer decisions increase consistency. Every extra decision point is a chance for emotions to take over. The market doesn't reward control. It rewards survival, and survival comes from controlling risk, not trying to control randomness.